Welcome back to the deep dive. Today we're diving into something really interesting. It's how the S&P 500 tends to perform, uh, you know, between election day and the end of the year, specifically in those U.S. presidential election years. And, right off the bat, I want to be super clear about something. When we talk about the S&P 500 in an election year, we're only focusing on like that specific window,
hmm
you know, from when the market opens on election day to the closing bell on December 31st of that same year.
Yeah, that's a really fascinating area to explore, because the S&P 500 is often seen as kind of a barometer of the US economy. So its behavior during these politically charged times, it can be really revealing about investor sentiment.
Okay, so what you're saying is,
Yeah.
by looking at how the S&P 500 acts during this post-election period, we can get a glimpse into what investors are thinking and feeling,
Yeah.
even if they don't come right out and tell us.
Exactly. And what's really intriguing is that historically, the S&P 500 has shown this surprising tendency to finish the year on a high note after election day.
Really, so even with all the uncertainty that comes with elections, the market tends to rally. I mean, that seems counterintuitive, doesn't it?
It does on the surface, but the data tells a pretty compelling story.
hmm
Since 1928, we've seen a bullish outcome, meaning the S&P 500 closed higher between election day and the end of the year in 16 election years, compared to only 8 years where it finished lower.
So you're talking almost a 2-to-1 ratio, favoring a post-election rally. That's pretty remarkable when you think about all the political drama and economic uncertainties that usually surround election years.
It is, and here's another fascinating detail. There have never been two consecutive bearish election years in that same time frame.
Wait, seriously, not even once? That's wild. Even during major crises like, say, the Great Depression or the 2008 financial meltdown.
Yep, even then. It seems like no matter how turbulent the year might be, the market has this built-in resilience when it comes to the period right after a presidential election.
So it's almost like the country takes a collective deep breath. The dust settles, and investors are like, okay, let's get back to business. Almost like a post-election relief rally.
Yeah, it's a plausible explanation. This historical pattern seems to suggest that investors are ultimately betting on stability and perhaps even a bit of a boost from whatever policies the new administration might bring in.
Okay, so history tells us that the S&P 500 generally likes to end election years on a high note, but 2024 feels a bit different, would you say? I mean, the market has already had an incredible run in both 2023 and 2024. We're talking gains of 25% this year, on top of a 24% jump last year.
You're absolutely right. This year is unique. We're dealing with a market that's already soared to impressive heights, and there are some legitimate concerns about whether this momentum can be sustained. We've got those,
Cascade.
the economic headwinds like inflation and rising bond yields. That could throw a wrench into the works.
Exactly. It's like we're watching a high wire act, and we're all wondering if the performer can keep their balance or if it's all about to come crashing down. But before we get too caught up in the present, I think it would be helpful to take a closer look at some of those specific historical patterns you mentioned. Like, what stands out to you as we dig into the data?
One thing that jumps out is the average performance during those bullish and bearish years. In those 16 years where the S&P 500 ended higher, the average gain from election day to the end of the year was 4.55%. On the flip side, the 8 bearish years saw an average decline of 4.58%.
Wow. Those numbers are surprisingly similar given the opposite directions. It almost paints a picture of stability, wouldn't you say? Like the market tends to find a balance, regardless of whether it's moving up or down.
That's a really sharp observation. And what's even more interesting is that for decades, the S&P 500 followed this very predictable pattern of alternating between bullish and bearish outcomes. It was like a perfectly synchronized dance back and forth year after year.
So like a zigzag pattern on the charts, bullish one year, bearish the next, and so on.
Precisely. But this consistent back and forth was shattered in 1972 with Richard Nixon's reelection.
Ah, Nixon. That was a landslide victory, wasn't it?
It was. And it marked a turning point for the S&P 500's post-election behavior. Nixon's win brought about the first instance of back-to-back bullish reactions, breaking that decades-long pattern of alternating ups and downs.
Okay, so that's a pretty significant shift.
Mhm.
What do you think caused this change? Was it simply the overwhelming nature of Nixon's victory? Or were there like broader economic forces at play?
It's a question worth pondering, and it highlights the fact that while historical patterns can be insightful, they can also be broken. Markets are complex, and there are always factors that could disrupt even the most established trends.
That's a good point. It's a reminder that we need to stay flexible in our thinking and be prepared for the unexpected. But speaking of patterns, I'm curious about the streaks. What's the longest bullish streak we've seen in election years? Considering that post-election day window,
The longest streak on record is 4 consecutive bullish years, spanning from 1968 to 1984. That period covered the presidencies of Nixon, Carter, and Reagan, a pretty diverse mix of political landscapes. And here's a fun fact. If 2024 closes bullish, we'll be tying that record.
wow, that would be quite a feat to witness history in the making. Okay, so we've got the longest bullish streak, but what about the other end of the spectrum? What were the most dramatic gains and losses we've seen in this specific post-election period? You know, those years that really stand out.
Well, most dramatic gain occurred fairly recently. In 2020, during Joe Biden's election, the S&P 500 surged a remarkable 12.58% between Election Day and the end of the year.
That's a huge jump. Okay, but I'm also curious about the biggest drop. When did the market react most negatively in that post-election timeframe?
That would be back in 1948. After Harry Truman's surprise victory over Thomas Dewey, remember the infamous Dewey defeats Truman headline?
Oh yeah, talk about a major upset.
Well, it turns out the newspapers got it wrong,
And
and the market reacted with a sharp drop of almost 9% between Election Day and the end of that year.
ouch, that's a significant hit. It's a stark reminder that even when all signs seem to be pointing in one direction, the market can still throw a curveball.
Absolutely. Election years are full of surprises. And the market is constantly reflecting those shifting tides of sentiment and expectations. And as you pointed out earlier, 2024 is shaping up to be no different. We've got a market that's on a tear, but also facing some serious headwinds.
It's a real nail-biter. So what does all this historical data tell us about where we might be headed in the coming weeks?
That's the million-dollar question, isn't it? Let's shift gears now and explore the current market dynamics. I think you'll find it quite intriguing.
I'm all ears. Stay tuned, everyone, because we're about to dive into the heart of the matter.
Okay, so, we've established that, historically speaking, the S&P 500 has this tendency to rally after Election Day, when we're looking at that specific window of time.
Right, and that fact that there's never been two consecutive bearish election years
Yeah.
in that period is pretty mind-blowing.
Yeah, it's a compelling pattern. But, as with all things market-related, there are always caveats. And 2024 is presenting us with a unique set of circumstances that make it really difficult to predict what will happen in these next few weeks.
Okay, I'm intrigued. What makes this year so different?
Well, as we've discussed, the market has already experienced really exceptional gains, both this year and last. In fact, since its lowest point back in October 2022, the S&P 500 has surged by almost 70%.
That's a huge jump. So the question is, can this remarkable run continue? Can the market defy gravity and keep climbing?
Exactly. And the interesting thing is that there are compelling arguments on both sides of this debate. Some analysts believe the rally has more room to run, while others are sounding the alarm bells.
Okay, so let's break it down. What are the bulls saying? What's fueling their optimism?
Well, despite the impressive gains we've already seen, some analysts believe there's still potential for further growth. They point out that the S&P 500's advance over the past 2 years is actually less than half the average gain, seen in previous bull markets dating back to 1945.
So even with the market soaring like it has, there's historical precedent for even bigger rallies.
That's right. According to Brini Associates,
Yeah.
the average gain in those previous bull runs was a whopping 143%. That kind of puts things in perspective.
Wow. So even though the gains have been significant, we might not have hit the ceiling yet. That's pretty encouraging if you're bullish on the market.
Right. Another point the bulls are making is that investor sentiment remains largely positive. We've seen significant inflows into U.S. equities recently, suggesting that investors are still pretty confident about the market's trajectory.
So there's money pouring in, and history suggests we haven't reached the peak yet. But I know there's another side to this story. What are the bears worried about?
Well, the bears are understandably focused on, those economic headwinds we've mentioned. Valuations are high, bond yields are rising, and inflation is still a concern. These factors could potentially dampen the market's enthusiasm.
Right. Those are some pretty serious challenges. But is there anything specific about this year's rally that's making the bears extra cautious?
Yeah, one concern stems from the fact that historically those year-end rallies, the ones we're focusing on from Election Day to the end of the year, haven't been as robust. When the S&P 500 has already risen at least 20% in the same year.
So because the market's already up 25% this year, it might be a sign that we've already witnessed the peak of the rally.
Yeah.
Like maybe the market has front-loaded its gains
Yeah.
and won't have much more upward momentum in these remaining weeks.
Yeah, that's the argument some analysts are making, is like that classic saying, buy the rumor, sell the news. The election is over. The initial wave of excitement has passed, and now the market might be taking a breather.
Interesting. So is it a case of the bulls hoping for continued momentum versus the bears anticipating a slowdown or even a potential correction?
Yeah, that's a good way to summarize it, but of course there are always counter arguments to consider.
Now, I love a good debate.
Yeah.
Tell me more about these counter arguments. What are the other perspectives?
Well, some analysts argue that just because the market has already climbed significantly doesn't necessarily mean the rally is in jeopardy. They believe that valuations and investor sentiment can remain positive for a considerable period, even months, before a major pullback occurs.
So the bulls are saying, don't count us out yet. The party might go on for a while longer.
Yeah, that's essentially their position. They point out that there aren't any clear signs of an imminent slowdown, and the market could continue to grind higher, even if the pace of gains moderates.
So it's like a marathon runner who's already covered a lot of ground, but still has enough stamina to push towards the finish line. It's not necessarily a sprint to the end, but rather a steady climb.
That's a great analogy, and this is where things get even more interesting, because simply focusing on the overall performance of the S&P 500 might not give us the whole picture.
Oh, I knew you were going to say that. We're all about going deep here. So what else should we be looking at beyond the S&P 500's top line numbers?
Well, one important indicator to consider is the S&P 500 equal weight index.
Now, that's not something you hear about every day. What's so special about this particular index?
Well, unlike the regular S&P 500, which is weighted by market capitalization, meaning that larger companies have a bigger influence, the equal weight index gives each company an equal weighting, regardless of its size.
So it's like leveling the playing field
Yeah.
and giving those smaller companies a chance to shine.
Exactly. And what's particularly interesting in this context is that it allows us to see if the gains are broadening beyond just those mega cap tech giants that have been driving the market higher this year. If we start seeing money flowing into the smaller components of the index, it would be a sign that the rally is becoming more sustainable and less reliant on just a handful of big names.
So it's not just about the overall index going up,
Yeah.
but also about the breadth of the rally. We want to see a rising tide lifting all boats, not just the luxury yachts.
That's a perfect way to put it. And along with the S&P 500 equal weight index, there's another crucial factor we need to consider, perhaps the most crucial of all, and that's the bond market.
Ah, the bond market. Always lurking in the shadows, but often holding the key to understanding what's really going on in the broader financial landscape.
That's a great way to describe it. And right now, the bond market is sending some mixed signals. Treasury yields have been climbing in recent weeks, which can sometimes indicate that. Investors are getting a little bit nervous about the economic outlook.
So rising bond yields could be a sign that investors are starting to shift their money out of stocks and into the perceived safety of bonds.
Yeah, that's one possible interpretation. If bond yields continue to rise, it could put a damper on the stock market's rally.
It's like a tug of war between stocks and bonds. Investors have to decide where to allocate their resources. And if bonds start looking more attractive, it could drain some of the enthusiasm from the stock market.
Precisely. It's a delicate balancing act. And the bond market can often act as a leading indicator of potential shifts in the stock market.
So we've got the S&P 500 equal weight index and the bond market, two crucial areas to keep an eye on as we try to decipher the market's next move. But I know there's always more to the story than just numbers and charts.
You're absolutely right. Those economic headwinds we talked about, inflation, interest rates, global events, they all play a role in shaping the market's direction. It's a complex interplay of forces.
Exactly. It's like a giant jigsaw puzzle with all these interconnected pieces.
Yeah.
But that's what makes it so fascinating, right? The market is always challenging us to think critically, connect the dots, and try to anticipate what's coming next.
Couldn't have said it better myself. It's a constant process of learning, adapting, and refining our understanding of this intricate system.
Okay, so we've explored, those fascinating historical patterns we talked about. And we've dug into the current market dynamics with all its complexities and, all those conflicting signals we discussed.
Yeah, we've certainly covered a lot of ground.
We have. But you know what they say? The more you learn, the more you realize you don't know.
Yeah, that's the beauty of it. The markets are constantly evolving, presenting us with new challenges and opportunities to learn and adapt.
Exactly. But even with all this knowledge we've gained, there's still this, one big question looming over us.
Well, will history repeat itself?
That's the million-dollar question, isn't it?
Yeah.
Will the S&P 500 continue its historical trend and rally in this post-election period? Or will those economic headwinds and unique market conditions we've discussed, lead to a different outcome?
It's funny. When you frame it that way, it's almost like we're watching a contest. between historical precedent and current market forces.
like a tug of war between the bulls and the bears, with history cheering on the bulls from the sidelines.
And as we know all too well, the markets don't always follow the script. There are always surprises, twists, and turns that keep us on our toes.
Yeah, if we could predict the future with certainty, I think we'd all be relaxing on a beach somewhere, sipping cocktails and letting our portfolios manage themselves.
I think you might be onto something there. But alas, the markets rarely cooperate with our desire for predictability and easy answers.
That's for sure. But I guess it's also what makes it so exciting, right? There's a certain thrill in trying to decipher those signals and
Hmm.
anticipate potential shifts and ultimately make informed decisions in the face of uncertainty.
Yeah, I completely agree. And while we can't predict the future with absolute certainty, we can equip ourselves with knowledge, understand the historical context,
Yeah.
and pay attention to those key indicators we've discussed. Those can provide really valuable insights.
Knowledge is power, as they say, especially when it comes to navigating the often unpredictable world of investing.
Well said. And this whole discussion has brought up a thought-provoking question, I think, that's worth pondering.
Ooh, I do love a good brain teaser.
Yeah.
Hit me with it.
Okay, so let's say those bond market warning signs continue to flash. Those yields keep rising, and investors become increasingly concerned about the economic outlook. Do you think the S&P 500's historical resilience, that tendency to rally after an election, will be enough to overcome those concerns? Or will the bond market's gravitational pull prove to be too strong?
That's a great question. It really makes you think about the potential clash between historical trends and current market realities.
It does, and there's no easy answer. It'll be fascinating to see how this all unfolds in the coming weeks.
Absolutely. And for all our listeners out there, you know who you are. I encourage you to keep your eyes on the prize. Pay attention to those key indicators. And most importantly, form your own conclusions.
Yeah, don't just take our word for it. Do your own research, analyze the data, and develop your own perspective on the market's potential trajectory.
And hey, if you come up with any brilliant insights
Yeah.
or have any burning questions, don't hesitate to reach out. We're always eager to hear from fellow deep divers.
Until next time, happy investing, everyone.